it's not necessarily a strategy, but it's a system that we use to trade. And I'm trying to think of the best way to approach it. So okay, let's just start out with this. You have your typical double top, right? Where price comes up, and what do most people do when they sell the double top, right? So prices come up to one level once and rejected, and come up to that same level, and at this point they might see some type of bearish candle, bearish engulfing candle, or whatever. And so people are taught, 97% of traders are taught to sell at this region and put their stops above the high, right? Stop somewhere in this region above the high. Okay. But the issue with that is that the banks, the liquidity providers, they know how people are trading. They know that most people trade the exact same strategy in the exact same way, and they're taught to sell double tops. Now, why is it that a lot of times these double tops end up not working out, or you end up getting stopped out, which I've been myriad times stopped out before the real move happens? The reason is because these banks, hedge funds, whatever, market makers, they need people on the other side of the trade before the trade occurs. So, in other words, they need, if the market makers were to sell here at the same point as everyone else, the market would simply die. It would just fall off the face of the earth. But then that's in and of itself is inefficient movement. It's inefficient pricing. That can't happen. So when I said they need other people on the other side of the trade so that they can take the sell, right? Because it will sell off, right? But typically, as a retail trader, you probably get stopped out before the real move. It's going short. It's going lower. Oftentimes, you get stopped out. So, like I said, they need people on the other side of the trade. So there's not only stop losses up here, but there's buy stops, right? Because people put their buy stop here. If price breaks this level, it'll activate them into buys, whatever. We call this a pocket of money. Pocket of money. There are stop losses and buy stops above this double top. Lots of money. So what the banks will do is they will entice people, maybe with a bearish candle or a couple bearish candles here at this double top. They will entice people to go short, therefore creating a pocket of money. Stop losses, buy stops. But we know, smart traders, smart money knows that the banks will collect this pocket of money. That is their job before the real move happens. So we're not getting enticed here at this double top. All right. So banks will entice, and then they will push price up into the pocket of money. They will pump millions and millions and millions of dollars into the pocket of money as a hedge, right? Because they figure, okay, let's just hypothetically speaking, let's say there's $50 million in the pocket of money. Let's say the market makers know that on the short side, on the sell, they're going to make 200 million. Well, if they can make 250, that's even better for them, right? That way they get their end of year bonus, whatever. But their idea is to collect that money, 50 million, then make that 200. All right? But at the same time, they're pumping money into the market, collecting people's stop losses. So people who are selling here are forced to buy back their positions, right? When it hits their stop loss, they are buying back their positions. And that comes into where I said they need people on the other side of the market, right? There has to be sellers or there has to be buyers to match sellers, right? So they're not only triggering the buy stops, but they're collecting the stop losses of the sellers that are selling from this double top, forcing these sellers to buy back their positions so that they can sell against them. See what I'm saying? But so that's the first understanding, is this pocket of money. What they're doing here to entice people to go short already, and then pumping a hedge, pumping money into the market to collect the pocket of money, and then a very fast move down occurs. That's ugly. And then you get your real move that most people, retail traders, 99% of people missed out on. All right, and it's going to be violent. It's going to be fast because smart money is behind that move. So what we do, we never know. We don't trade like the banks because we don't have that volume. We don't have that capability. We don't have all that capital to be able to move the market. But we can understand that these liquidity providers leave clues for us to capitalize on. And this is essentially what it is. We're looking for areas. We are looking for pockets of money to be purged, right? So the idea is we can see this type of movement where the pocket of money is purged, right? Stop losses are collected, buy stops are triggered, and then we're looking for that violent move down in the right direction. All right, that's our clue that the bank has left. That okay, they're in these cells now, right? The banks, the liquidity providers are in these cells, and this is the clue that they leave right here. Entice, fast push up, fast push down. Now, what we can also understand is that when they pump these millions of dollars into the market to buy it up, they then sell it immediately and leave those buy orders in as a hedge, right? So the further price goes down, the more in drawdown their buy orders. And here, they have buy orders in these candles. The more they get in drawdown as price continues down, right? So they're in buys, price closes up here, and then they sell it immediately. And these buy positions are in drawdown now, right? So they don't want to keep selling it, right? Because then they'd be even in further loss in their buy hedge. So what the banks do is they push price up. They push price up to the candle that took out the liquidity, the candle that purged that pocket of money. They push price back up to that candle to mitigate out of that candle, to account for that candle, to break even on the buys. They need to break even on the buys, get up to that level where that volume candle, that candle that has all the volume, the buy orders in it, that took that pocket of money, they need to get price back up there to that price point so that they can break even, get out of them. And then that's where we enter. We enter off what's called the mitigation, and I'm going to show you examples. I know this is kind of messy, but this is kind of trying to understand the principles behind it. They break even on those buys. What happens when there's less buying pressure, less buying volume in the market, right? If they're getting out of those buys, that then opens up even more selling volume, right? Because buying is out, which means if you think of it as like a seesaw, buying volume is out. That gives sellers, aka their sell positions that they were already entered into here, even more steam. Okay, so a little recap. Pockets of money, double tops, or they're enticing, right? Or just there's liquidity, pocket of money, above or below every swing point in the market. We're looking for these swing points or these highs or lows or double tops or double bottoms to be purged with a fast move, and then an immediate fast move in the opposite direction, the direction you thought it was going to go in the first place as a retail trader before you got stopped out, right? Oh crap! So that's essentially what we're looking for. And it can go into more detail, but that it's honestly not that complicated. It's very simple. It's just a matter of training your eyes to see the manipulation, to see the pockets of money purged, and identifying the proper candles to play off the mitigation, right? Because we're simply playing it off here when they come up to mitigate out of their buys. All right, so I'm going to go into some examples. All right. Oh crap! Get rid of all this. All right. And you can see this type of behavior on every single time frame. Right? Price doesn't understand time. Price only understands price. So you can trade the same principles on the monthly, the weekly, the daily, the 1 minute, the 5 minute. Right? So here we go for an example. You can see here the daily price created what appeared to be a double bottom, right? Equal lows. Spike. Most retail traders would try to go long here and target, I don't know, somewhere up there. But as smart money traders, we understand that, okay, this is great. Price has left equal lows. That means there is a ton of liquidity beneath those lows. All right? Ton of liquidity. So, we're patient, we wait. We wait for price to purge this liquidity, to capture it, and then we look to enter our trades. So, in this example in the daily time frame, what often happens is, like I was explaining earlier, when they push price up or they push price down, and then you get an immediate reversal in the opposite direction, it's often that last up move before the down move, the last up candle before the strong down push that has the volume that we're looking to mitigate out of. And if vice versa, if it's a double bottom, it's often the last down candle before the up move that we're looking to mitigate out of. That's where the most sell orders are still trapped and in drawdown. The last sell before the buy, or vice versa, the last buy before the big sell. All right, and those candles, the buy to sell or the sell to buy, need to, as a rule, have captured liquidity, have taken out pocket of money. You can even classify these lows here, and probably more easily identifiable on a lower time frame as liquidity. These lows, boom, sell, buy, liquidity here captured, liquidity here captured. So how do we play it? How do we play the mitigation? Well, the majority of the volume in a candle, and in the candles of interest that we identify as a sell that captured all this liquidity before the big buy, the majority of the orders are stored in the open of that candle, which we mark off, the open, and then the 50% is essentially an algorithm the banks use where the volume and candles are. So the open, and we're going to measure the 50% of the body. Use the fib. 50% of the body. Okay. So this would be our buy zone. We would anywhere from the open to the 50% would be our buy zone. You could a lot of people I know only take positions off the 50. A lot of people I know only take it off the open. A lot of people I know put half their position at the open and half at the 50. But what does price do? Plain as day. Sell, purge liquidity. Buy. They have to come down, like I said, right, to mitigate out of their sell positions. Get out of it. Break even. Once, twice, tap this line to the T, and we explode. Simple as that. Simple as that. Okay? And, I can show myriad examples of it. Let's go to USDCAD. Because I can think of a great example here. It happened it happens every day, not every time frame, but for example purposes, this was a beautiful trade. All right. So you can see price has been trapped in this range for quite some time. You had equal high, equal high, equal high, equal high, right? Building so much money, liquidity above these highs, stop losses, buy stops, you name it, in this range. All right. So smart money. We're not looking to sell at these equal highs, like the sheep do, right? Like the herd. We're not the herd. All right. We're waiting for the liquidity to be purged, and it always happens. If not now, okay. Retail lucked out. Boom. They might have caught 30 pips. Might have caught 30 pips. Might have caught 50 pips. Whatever. All right. Fine. But we're waiting for the move where we can see that the market makers have left clues. The real true move. And you can see easily this buy, and then we had a very big sell-off. Right? We broke the range. We broke the structure. All right? All of this liquidity in here was purged, taken out with this violent move. Boom, up and immediately down. All right? And we can see that. But we're not looking to sell here. We're not looking to sell all the breakout down here of the range. We know that the banks need to get out of these buys here. This buy candle before the sell. We know they need to mitigate out of it. All right? So we wait patiently. We mark off the open where the majority of the orders are. We mark that off. And I'm personally, my personality, I really only look to take trades off the open. I can do the 50% sometimes, but I really like to take it off the open. I place my limit there. I place my limit at the open. Okay, the open of that candle. Orders are trapped there. They're buy orders. Boom. Price starts creeping up, creeping up, creeping up. All right. Up. People think this is just the retest maybe of the halfway point of this range. They start selling here again. That creates more liquidity in here for them to then boom, push up, capture this liquidity, mitigate out of this candle, buy to sell to the T. You see that? To the T, and it doesn't happen. You think this is a coincidence? Doesn't happen for a reason. You might have had half a pip of drawdown, and then there we go, a massive sell-off. Massive sell-off. Because smart money is behind this move, because they've finally broken even on these buys that they were hedged against, right? They were in these buys, and then boom, they sold it off. They're still in drawdown. Oh, we got to get out of drawdown. We got to mitigate out. mitigate it out, boom. And you can still be in this trade. The smart money's behind it. Yeah, we had a significant correction, but I mean, it's still the same principles apply. Lower low, lower low. All right, we could potentially come down here and create a lower low. But you can see in a real life example what I was talking about at the beginning of the video. Buy, sell, mitigate, drop. Boom, place your sell limit right at the open of that candle. Your stop loss as a rule goes above the close of that candle, right? So your stop loss would simply go here, because if it hits that, then it's invalidated. We call this candle here, this buy candle before the sell, an FU candle, right? Because they're screwing everyone, the retail traders, or a sponsor candle. I prefer sponsor candle. It's an institutionally sponsored candle, sponsorship candle. Okay. So one last example, and it's actually a trade I'm in today. Is EURCAD. EURCAD. I'm in this right now, floating 50-ish pips in profit, I think. So, and oftentimes it's really the last buy before a violent move, or a last sell before a violent move that has trapped the volume or trapped liquidity. Okay, so and even this year it took out some form of liquidity, resting in here, resting in here, whatever. But you can see the quick move up and the violent move down. We can also see that price created a double top here where people are trying to sell from, right? A triple top. Look at that. People are trying to sell from here. Boom. Stop loss is somewhere up in here. Their stop loss is where I'm entering. Okay? Because I understand that. I see the pocket of money. I can see the pocket of money being created. And I can see that this candle has not been mitigated out of. Right? They've still been in drawdown in this buy right here. So what do? They create the pocket of money. They all the liquidity in here, and they spike it up. They spike price up, and then to the T, mitigates out of their hedge. They mitigate out of their hedge. Where can we target? Well, we can see here. They're going to take out this liquidity. They're going to take out all this liquidity, right? That's their job. Their job is to simply take out highs and lows and swing points. These equal lows, tons of liquidity, big pocket of money beneath. They're going to take it out. Equal lows, are you kidding me? So, yeah, this was kind of a hefty stop loss because this buy before the sell was such a big volume range candle. So it was 36 pips, but usually it's no more than 15. But I like to stick around the 7 to 10 pip stop loss range because I can use a 7 to 10 pip stop loss, 100 pip take profit, and I have a 1 to 10. 1 to 10 risk to reward. That's what it's all about. Risk to reward. I could lose 6, 7 out of 10. Let's say I risk 1% per trade. I can lose 6, 7 out of 10, lose 7%, right? But win 3 at 1 to 10, that's 30%. And I net 22%, even though I've only won 3 out of 10. Come on. I'm not saying that you should only win 3 out of 10. The goal, obviously, is to be as accurate as possible. Think about winning 70% of your trade at 1 to 5, 1 to 10. 70% of your trades at that type of risk to reward. Think about how profitable you can be. But yeah, quite simple. Violent push up, violent push down. Create this liquidity in here. Capture the liquidity. Mitigate out of the buys. Boom. Quick entry to the T. To the T. No drawdown. Sometimes I get these entries that don't even activate me because the spread. That's how precise this is. There's no guessing game to it as long as the rules are met. Okay?